As investors, we are always looking to generate passive income with our investments. Making money off our money. And historically, the best and most reliable way to do so is by investing in companies that pay you dividends and then compounding those profits over many years. But there are a lot of details within a dividend investing strategy that a lot of people might not know about, myself included for the longest time. So in today's video, we will break down everything that you need to know, including how dividends really work, the best strategy to use with your portfolio, combining options with dividends, and also some solid stocks that pay you free money just to own it. Now, at the end of this video, I will also give you a little bonus tip that will make everything so much easier. So if you're ready, then so am I. Let's begin. Ladies and gentlemen, my name is Alex Pandrea and welcome back to Pandrea Finance. Let's just jump right into it. But hit the like button first so that we can begin properly. Talking to you out there, Michael. There's somebody out there named Michael watching me like, he's talking to me. Okay, so what is a dividend and what do we need to know about them to make us the most amount of return possible? A dividend is a distribution of the company's earnings back to its shareholders. Basically, the company will pay you a piece of their profits for holding shares in their company as a reward. Thanks for investing with us. Now here's some money. Oh, thank you very much. Now, not all companies pay a dividend and not all dividend payments are the same. Some companies choose not to pay a dividend because they believe that reinvesting their profits back into the company to grow is a better use of their cash. And the companies that do pay a dividend will choose to only pay a percentage of their profits back to the shareholders. So for every share that you own of the company, that company will pay you a certain dollar amount. This payment is called a dividend payout. Dividends can be paid out monthly, quarterly, or yearly. The dividend yield, which represents the percentage a company pays shareholders, is calculated by dividing its annual dividend payout by its current stock price. So if a company is trading at $20, let's say, and it has a dividend payout of $1 per share annually, then its dividend yield is 0.005 or 5%. This is your annual return in dividend payments for investing in the company, excluding potential appreciation of the stock price. Now, one very important thing to keep in mind is that since the dividend yield is dependent on the stock price, then it will constantly change and is inversely correlated to the stock's price. As the stock price moves up, the dividend yield percentage will go down. As the stock moves down, the dividend yield will go up. So in our prior example, if the stock price moves up from $20 to, let's say, $40, just for sake of argument, then the calculation will be the $1 annual payment divided by $40 now, which now gives us a dividend yield of 2.5 rather than 5%. This is why as companies grow and their share price increases over time, the dividend payment will increase as well to compensate for the lower yield. Now, when putting together the perfect dividend portfolio, there are a few things that you need to look for. The last thing of which being the dividend yield. See, many new investors fall into the trap of searching up for high yield dividend paying stocks and automatically think that this is a good investment, not taking into account some of the more important factors. So let's break it down. If you see a dividend yield of a company increasing, we now know that this is a sign that the company's share price is going down. As the share price goes down, the company's dividend yield will go up, right? And if the share price continues to decrease, the company can cut their dividends or even stop paying altogether. This is why you want to look for dividend aristocrat stocks. Dividend aristocrats are companies that are both in the S&P 500 index and have paid and raised their dividend for at least 25 consecutive years. That's a long time. They also require a certain market cap and shares traded in a given time period, so you know that they are a mature and solid company. Two great examples of this are Coca-Cola and Johnson & Johnson. Coca-Cola, ticker symbol KO, has a dividend payout of $1.76 per share, which is an annualized yield of 2.95%. Johnson & Johnson pays $4.24 per share, which is a 2.41% yield. Both these companies have increased their dividends constantly as the companies grew, which is a great sign for the stability payments of these dividends into the future. Now, here is an important note on dividends. They are taxed at a much lower rate than regular income. You can see here that even at the highest percentage, you are still paying way less in taxes than you would if it were to be considered as regular income or in the short-term capital gains category. This is a good thing. Start your dividend investing journey today with a special promotion going on right now with Webull. Webull is giving away up to $3,300 when you sign up and fund your account. All you have to do is open an account to get 2 free stocks valued anywhere between $3 and $300. Then when you make a deposit of any amount, you'll get 3 more stocks valued anywhere between $8 and $3,000. Webull has now expanded into cryptocurrencies as well. Go claim your free $5 in crypto when you fund your account with just $1. Pretty nice deal. Thanks, Webull. Another factor in picking great dividend stocks is the same in picking any stocks, really, and that is to look at their financial statements. And more importantly, their cash and their debt. An increase in earnings and profit means it's much more likely for the company to be able to raise their dividends because they have more cash on the balance sheet. If a company has a lot of debt, then that could hinder its abilities to constantly pay you. You can also take a look at companies' payout ratio. The dividend payout ratio is the ratio of the total amount of dividends paid out to the shareholders relative to the net income of the company. So basically this means how much of a percentage of the company's earnings do they pay back to you, the shareholder. Some companies pay a small amount of their earnings back to the shareholders, while other companies may pay out all their earnings back. You get dividends, you get dividends. That joke's so played out already. All right. The payout ratio is calculated by taking the dividends paid and dividing it by the net income of the company. Now, this percentage can tell us a few things. A lower percentage payout ratio means the company is deciding to keep most of its profits and reinvest them back into growing the company. This is why you see companies who grow more pay less dividends relative to how much they earn. A high percentage payout ratio would mean the company is deciding to pay a majority of their profits back to us, the shareholders. And in turn can lead to less growth in the actual stock price because again, you're not investing back into growing the company, growing profits and earnings. This usually happens with more mature companies that have already grown to its full capacity and can do very little with that cash to grow the company even more. So they decide, hey, here are some shareholders, let's give them money. One of my favorite dividend paying companies is JP Morgan Chase. Now, it pays a dividend of $4 per share and has increased its dividend for 11 straight years. Pretty good. It has a payout ratio of 26% and has kept that percentage steady for the last decade. Now, even though, I'll be honest, they could work on their customer service, Chase, come on now. I think it is a solid company that for me is worth owning. At least the dividends will make up for all those overdraft fees that they love to charge. Now, you don't just want stocks alone in your perfect portfolio because stocks represent only one form of dividend income. You want to be diversified with different types of dividends. For example, another very popular form of passive income would be rental income, right? You buy a house and then you rent it out and you collect a form of dividend payment in the rent. But if you want to invest in the market and have the same exposure as these rental incomes and make dividends off of mortgage loans and things like that, then we can look to REITs, which REITs are real estate investment trusts. These are companies that own, operate, or finance income-generating real estate. They basically do all the heavy lifting for you because let's be honest, you have to go out and find a house and buy a house, rent it out, manage it, fix up things. Or you can just invest in a company that takes care of all that for you and then pays you a piece of their profits. Hey everybody, we have all of these commercial properties and apartment buildings. Invest with us and we'll share the profit with you. How does that sound? Where do I sign up? My favorite REITs are MFA Financial, ticker symbol MFA, and Arbor Realty Trust, ticker symbol ABR. These companies pay 8% and 9% yields respectively. This is a crazy amount, right? But there is an asterisk to that. So please keep this in mind because this is important. Dividend payments from REITs are considered non-qualified. Now, what does this mean? So this means that they will be taxed at the normal income rate, which would be a higher rate than what you would pay if you were just holding dividend paying stocks. So you need to take that into effect when investing in these companies. Same thing applies to business development corporations. These companies provide exposure to things like private companies and equity, usually investing in distressed companies and getting them profitable. And investing in these will get you a piece of their profits. My two favorite are Main Street Capital, ticker symbol MAIN, and Gladstone Capital, which is GLAD. They both pay around a 6 to 7% dividend yield. For the diversification aspect, I think it's important to add these into the perfect portfolio for exposure to many different types of income, so that you're not just relying on one sector. This brings me to high yield ETFs. There are two specific ETFs that I think any investor should have in their dividend portfolio, because this will provide an overall exposure to the entire market. But more so, I think these ETFs are even more important for capital preservation and consistent passive income. For example, if you've worked hard and invested wisely throughout your life and made a few $1,000,000 by reinvesting and compounding your earnings along many years, which is more than possible for everybody out there watching by retirement to do so, you can then put everything into these ETFs and collect a dividend payment and just live off of this income for the rest of your life. The idea is to only spend the interest that you're collecting and never touch the principal. The first ETF is SPHD, which is the Invesco High Dividend S&P 500 portfolio. This tracks the highest yielding stocks from the S&P 500. This ETF pays a 3 to 4% dividend yield as an annual return on your money. Now, this won't appreciate as much as something like the SPY, but because we're only focused on collecting income at a certain point, this might be a good trade-off. The second ETF is the iShares Dow Jones International Select Dividend ETF, ticker symbol IDV. This tracks 100 of the highest yielding securities in developed countries outside of the US. Now, I think this is very important to be diversified worldwide and not just in one market. This ETF pays close to a 4% yield as well, so pretty nice. Okay, now for some bonus tips for your dividend portfolio. First tip is to use dividend.com. This is my go-to site for checking dividend yields, payout ratios, and even dividend capture strategies. This is where they tell you exactly when you should purchase the stock to be eligible for the dividend payment, the upcoming ex-dividend date, and how long you should hold the stock after the dividend payout for the best return historically. The second bonus tip would be to set up a dividend reinvestment plan or DRIP. This is where your brokerage would automatically reinvest your dividends back into your portfolio. This is very important for compounding your profits year after year. Collecting dividends over time allows you to purchase more shares with the cash that you receive. Now, the more shares that you have, the more dividends you will further receive. And this creates a snowball effect that, left long enough, will build you a lot of wealth. Also, because we love using options here on this channel, you may want to explore combining selling covered calls on dividend paying stocks. This way you will not only receive a dividend payment, but also premium that you collect for selling call options on your stock. Now, if you want to learn to sell covered calls and generate passive income, I did a whole video on which you can watch right over here. And if you want to see what I'm investing in, go ahead, check the link down below to my Patreon. This is my private community. I share what I'm invested in, my thoughts on the market. Link is down below. Go watch my other videos, hit the like button, subscribe, hit the bell, do all the stuff, and share this video if you think somebody might enjoy it. Thanks so much, and we will see you on the next one.